Job growth is a key metric investors look at to time and time again for signs of strengths, sometimes cracks in the economy. While concern continues, certainly, around strong employment leading to the inflation story, our next guest notes that it's hard to find a correlation between the two on a historical basis. We'll dig into that. She goes on to say that the current payroll data isn't too strong for the Fed to cut rates. So could this be possibly what non-inflationary growth actually looks like? Here to discuss and for a look at which sectors are on her radar is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Hi, Denise. How are you?
Well, I'm well. How are you?
Very well, thanks. It's great to see you. And we want to dig into this discussion of what the seemingly very powerful job growth numbers that we keep getting in mean for pumping up inflation and how we should be looking at that.
Zooming out can give a lot of perspective, and really from a job growth perspective, only in the sense that the payrolls were above expectations for the last couple of months is really the only statistical reason you could call them strong. When you zoom back out and you look at year-on-year payroll growth in terms of non-farm payrolls, or even a 3-month or 6-month clip, what you'll find is when you quartile it out in history, and anybody who's interested in these charts can see them on my LinkedIn, what you'll find is we're only in the second quartile. And the interesting part about that is we're not seeing any anomalous surge in employment growth. And when you look at this broadly and say, what correlation do you see in terms of this segment or this quartile in terms of payroll growth equating to in terms of average inflation? And you'll find it's bang on 2% growth. So this is to your point.
The target.
Exactly. It's not like it leads to something much stronger historically. And I do think that there's some slippage when you look in terms of what people think is the corollary. So payrolls drive service spending, which may drive service inflation, but that's only one piece of the overall CPI. And more importantly, doesn't include productivity. So when you think about what wages are growing and meaning that service inflation might be quote unquote stickier at say 3.5%, well, if productivity is growing at 2%, then you're all of a sudden down to a 1.5% to 2% range of inflation. So investors need to understand that you do need to back out some productivity to get to a run rate of inflation. And that's why I think that a lot of what we look at in terms of, or a lot of what we talk about in terms of payroll growth, or even just the ahead of expectations CPI, might not be nearly as bad as you think from an investment perspective as it relates to either overall inflation or, more importantly, the equity markets.
Okay, so the equity markets need to see ultimately what is it that they need to see from these numbers? What do they need to see through the numbers, I guess, is the question.
That's right. I think that they may need to see through the numbers, but I think that we are living that over the last year and a half. As much as angst there was about how many times is the Fed going to cut, well, it was going to be 6 and now it's going to be 2, and it was 6 and then 0 last year. What you'll find is, again, what you find historically, what we have experienced over the last 2 years, which is when you evaporate those questionable Fed cut impacts, what you'll find is the equity market more often than not advances, meaning that the equity market is much, much less dependent on a Federal Reserve rate cut than many investors think. So remember, when you think about what inflation or even overall rates mean, when you're in that, like I'm going to call it second quartile, muddy middle range and accelerating or decelerating, it usually isn't the biggest overall impact on the market. Other things matter more, and we're seeing that again play out with earnings mattering more. But I think that even backing up, what matters more? Interest rates or overall growth? And you will find very clearly historically in that rock, paper, scissors measure of what matters, it is growth over interest rates, meaning that higher rates are more often than not a reflection of growth, not a deterrent to it. So when you sort of zoom out, what you'll find is that I'm not so sure that the stock market is dependent on a Fed cut. The risk reward can still be positive for the equity market, even if the Federal Reserve doesn't cut interest rates this year.
Okay, for instance, so when we look at earnings so far that have been coming in have been fine for this quarter, for first quarter. The thought was we'll be down the road further by Q2, by Q3 with interest rate cuts. At the beginning of the year, we sort of walked into it thinking, Q1 might be fine, but really things might get going once the interest rate cuts get sort of rolling. And that was expected a bit later in the year. We're kind of entering that time of year and we have no rate cuts in sight. So if it's less dependent, that's great. But what is still priced in on interest rate cuts coming in at this point?
Yeah, so when I look at what the equity market is pricing in, right? Let's not talk about the bond market in terms of expectations. I think expectations in the bond market are down to 2 cuts, I think starting in July or September. And the reason why I actually don't look at that is because what we just talked about, it's not really predictive for the equity markets overall. When I think about what the equity market is pricing in, a lot of investors will point to the fact that, well, the equity market is up a lot. So that means that they're expecting Fed cuts, or the stock market is very expensive. So it's priced for perfection. Neither of those two things, when I look at it, are predictive of what the equity market does in the next year. And in fact, it's the opposite of what you would think. The more the equity market advances, like we've seen, the more likely it is to advance in the future, partly because the equity market is in fact sniffing out something that you as an investor might not be expecting, namely that the earnings numbers that we're seeing are not only strong this quarter, but they are likely more durable. So the market potentially shifts to the air of durability of the recovery, which actually does deserve a higher multiple to the extent that earnings growth is durable. If you think about how this plays out, what it means is that you are less dependent on interest rate cuts and you are more dependent on earnings growth that might be more persistent than investors expect.
When we dig into the earnings growth, margins have been a big story for a long time, and we know that, and companies were able actually to raise prices, and then there was sort of another discussion of margins. Take us through what you see on kind of the revenue side of things. Like at some point, the growth story has to happen on the revenue side. It's not just sort of growing the earnings from in other ways.
Yes, and we are seeing it definitely be margins sort of recurring back to those all-time highs. And that is the one secular trend in specifically US equities that is higher cycle to cycle. And that's, if you want to, one thing to watch as an investor is keep your eye on that unit labor cost number. And that is usually a good inversion of what margins are likely to be. The lower unit labor costs are, and I expect them to keep kind of continuing downward, the higher it is likely that margin expansion will be. And that's been the upside in terms of earnings growth. To your point, revenue growth has still consistently slowed. And part of that is just inflation nominally coming down. But with inflation maybe sort of flattening out between, I'm going to call it 2 and 3.5, which is historically the sweet spot for equity market returns, you can also expect revenue growth or unit growth to potentially flatten out at the same time on a higher margin base. So more drops to the bottom line, making companies more profitable per unit of revenue growth. So I think that this is the sweet spot in terms of where you might be starting to see the durability of the economic recovery, the durability of the earnings growth recovery in this sort of virtuous cycle where unit growth is actually stabilizing with a higher margin reset. And that's very positive for equities.
And when you're looking into, you've mentioned productivity a couple of times. I feel in Canada, we've been pretty focused on productivity because it's a big part of where we think we need to get going faster. The productivity that you're seeing that comes into the margin story, that comes into the unit labor cost, just tell us a bit more how that's coming. I mean, the obvious question is sort of, is that AI driven? But what else is in there?
I doubt that it's AI driven yet. Right. So I think that is all still to come. It's likely a secular driver, not necessarily a cyclical driver right now. And it's anybody's guess why it's happening. My guess would be that actually work from home maybe was more productive than many people have expected. So I do think that, with the workforce not declining so much, because it didn't decline at all in what I'm going to call a recession, sort of the job full recession that we saw in 2022, what we've seen is that restabilization where, you saw it literally scroll through an unproductive workforce to a much more productive workforce with sort of higher cycle to cycle productivity. So we're back to trend productivity without the job loss that we typically see during recession. So unit costs, unit labor costs are actually much, much lower. And in fact, I mean, if they continue down to where like the trajectory actually suggests, we might actually be back down to the post-GFC unit labor cost area of growth, which is, again, very, very bullish for profit margins.
And then just take this all back, because we started out saying that the payrolls numbers or the jobs numbers that we're looking at are poor predictors. So that was sort of point of it. So just kind of take us through where we're seeing this, what we're returning to, but also why it's kind of a poor predictor of where we're going.
Yeah, it's just not a very good leading indicator of anything. And in fact, like I said, when you hyper focus on job payrolls,
we focus on it then, because we do. What's the deal?
Right. No, it's usually why I say I never really talk about payrolls. And this was the only note that I've written literally on payroll day, like why you shouldn't focus on payrolls. As much as that seems like it's a very strong number, it's very inflationary. When you zoom out and you actually give it some historical perspective, what you'll find is that this is the definition of non-inflationary growth. It is the sweet spot for jobs, not too strong, not too bad, because we have corporate profitability behind it. The profit recovery will create the durability of the cycle and probably squash layoffs to, a smaller extent. So that payroll number, again, the more you hyper focus on it month to month, it's A, not leading, B, not nearly as predictive of what you would think in terms of inflation. And then even if it was, inflation, in my opinion, based on the data that I analyze, is not as predictive of the equity market as you think. So again, that narrative of sticky inflation, I think might end up being correct, but I'm not sure that it's going to be a bad thing for the equity market. When you look at it historically, that what I'm going to call, non-inflationary growth sweet spot of, let's call it between 2 and 3.5 inflation overall CPI, is actually the sweet spot for the equity market historically.
So just to throw sort of more of the spaghetti problems in here and have you solve them for us, because I love doing this. The idea of risk in the markets, generally speaking, this goes to the equity story and everyone's appetite, investors' appetite for it. We've seen the VIX poke up through much higher rates. You've said in the past, though, that the risk story is buttressed by the fact that the Fed has a lot of essentially tools to use in its toolbox. It's got a lot of levers it can pull. So even when we do see spikes in the VIX, again, sort of take us through why, I guess, it's not as important to the equity market, because I suspect that's what you'll say.
Let's talk through two things. One, the Fed in terms of what they might do, and then the indicators of the market internals that I always watch, which is the VIX relative to credit spreads. But first, to your point of let's call it the Fed put, right? The fact that nominal rates are high enough now where if the economy actually encounters a shock, the Fed can cut rates. And they have said that. They have said, if we see a problem in payrolls, if we see a problem in the job market, or if inflation will allow us to cut, we will cut. And that is very, very meaningful to the market. That's why you see in that quartile of basically, bottom quartile inflation and top quartile nominal rates or short rates, you do see 70% of the time the Federal Reserve cuts. And because of that, you only have a 3% recession risk, which is not to say zero, and it's 3 out of 20, so I could renormalize that. But what it shows you is that the equity market understands that if there is trouble, there is something to offset the trouble. And this is true for the first time in 15 years, essentially. So that is the unique part of the equity market, and I think the unique part of the risk story that many investors are missing. And further on the VIX, now look, the VIX has been in complacent levels, which to me, if you ever see a chart, and I didn't do the chart, there's a bunch of other people who did the chart, but if you sort of green out VIX under, I think it's under 15, you'll see a secular bull market. Like if you overlay the colors on top of the S&P 500, you'll say, oh, I actually want a low VIX. But what you'll find is on our low VIX, we actually increased 50% over the course of the last 2 months, from that trough to a peak that we have recently seen. So with that, is that an indicator. So over the last 2 years, that has very much been a good entry point for equities. And when you back test it historically all the way back to the 90s, when you look at that 50% 2-month rise, what you'll find is it's monotonically correlated to better equity market returns in the future, which means that that is, I'm going to call it like the mathematical definition of the pause that refreshes. So it means that we had some shakeout. Now, look, I mean, there could certainly be further correction, but if you think about corrections either happening through price, which is usually sharp and swift, but you can't really time that bottom, or time, it goes sideways, not down a lot, but not up a lot either. For a longer period, we might be long in the tooth on either, especially true when you compare that VIX increase to what's happening in the credit market, which is not much at all. So
Right.
credit spreads have largely been flat when you've seen fear in the equity market. And you know, I've said that that's the one indicator that I look at, which is to say that when there's fear in the equity market and there's not, or the absence of fear in the credit market, usually, not 100% of the time, but usually the credit market is the better predictor. And that usually means that the market continues to climb whatever wall of worry it is that we are concerned about at the time. This time you could insert geopolitical risks and higher long-term rates. So this may very well be the market internals suggesting that this is just a pause that likely refreshes in terms of equities, creating an opportunity.
So let's talk about the geopolitical risk, because it certainly is on people's minds. It's certainly one of the reasons that people might be tepid at this point. I know you've often said it's something that you can't really measure, so you have to kind of go through it. Let's get into that a little bit. Those that would like to perhaps ignore it, how do they silence that a little bit and look through again?
Yeah, so there's two things when you can think about geopolitical risk. One is that it is tricky to measure, but when you do try and measure it, historically speaking, it doesn't correlate well to equity market returns. It's really frustrating. It might correlate for 3 or 4 days when something happens, but when you're a longer term investor, and by even longer term, I mean, 6 months to a year, you really see very little correlation. The one example, the always, notable example is World War II, when from 1937 to 1945, the stock market averaged 6% returns during, obviously, one of the biggest wars that we've seen in a century, essentially. But if you think about that lack of correlation, even though that we are fearful about it, I think that we can also think about the translation or transmission risk as it relates through crude oil, because that's really the geopolitical concern, which is to say, if energy producers are involved and we have yet another supply shock, that supply shock could cause an inflationary impulse, could cause the Fed to hike interest rates, and could be a shock to the U.S. consumer. Again, I can't exactly predict that. Nobody can. I shouldn't say I can't exactly. I can't predict that, and I don't think anybody can. But what you want to look at is the call it would create for crude oil to create enough of a shock to tip the average U.S. consumer into recession. Usually that shock as a percent of income is about 1.5% to 2.5%, which is to say that crude oil would have to get to something like, on a nominal basis, because incomes have grown so fast over the last 2 years on a nominal basis, crude oil would have to be something in the range of, let's call it 130 to 150 in terms of providing that typical shock. Not going to say that it can't happen, but it is to say that it's going to take much more out of crude oil than we have seen in the past to make that happen. So those are two things that I think investors should consider. One, that geopolitics are usually and even sometimes inversely correlated to market returns, as frustrating as it may seem. And then two, that crude oil risk might be very, very different from what we've seen in the past, because incomes have grown so rapidly, diminishing the potential for a crude oil shock this time around.
And I remember one of the things you've said in the past, another reason why you focus on sort of the discounting mechanism within markets and ultimately what that's going to tell you and show you and provide opportunities for. Because I think you'd mentioned there was a theory that even in a geopolitical, a very stressful time geopolitically, which probably World War II is a very good example of, it sometimes moderates the bull market. Have I got that right?
Yes.
There's a theory
Yes.
in there.
I would say that's a theory. I mean, it's very difficult. I tried to prove it in the data and you can't quite get there. But yes, the theory is that all of this geopolitical risk makes people nervous in terms of spending and makes corporations nervous in terms of spending, which means that there's very little probability of a boom time. And it's the boom times that actually correlate most with the bust times in terms of that cycle. So it may very well be all of this risk on the horizon moderates the cycle and makes it more durable for longer, as opposed to better growth and then worse growth in terms of the bust. So that, again, that is a theory. It's a little bit difficult to prove in the data, but that is one of the theories behind why geopolitical risks doesn't correlate as well as you might expect to equity market returns.
That's so fascinating. So fascinating. So when we think about at this point, some of the sectors that, I mean, sometimes Yuri and Timur will say we're kind of mid-cycle vibes, we're in different places. I don't know if any of the cyclical stories are where you're going to sit. You do different types of measurement often. Where does that take you in terms of the sectors that you like most, that you like least? Financials are, to some people, think they've had their run, or maybe they need to be put aside. Where does financials sit for you right now?
Yeah, financials looks like still the most interesting sector to me. And it's in part because when you think about a cycle, we do have an earnings cycle in terms of the fact that we are coming out of an earnings recession and we are now reaccelerating to pretty strong and decent earnings growth. And that's where I think Urian comes up with the mid-cycle vibes. That is very much a mid-cycle area. But where I see the opportunity is really in sectors that have discounted something of a much harder landing. And I see that more in financials, and I'd include real estate in this, than most other sectors. I say that because valuation spreads are very, very wide, which is a big gap between lowly valued stocks in the financial sector and richly valued stocks in the financial sector. And that usually means that investors are very fearful about whatever could go wrong. And to me, that looks really compelling, because the wider you see valuation spreads, the more likely there is alpha in that area of the market. You also have that joined by absolute valuation levels that I think are very compelling and usually skew your risk reward in terms of that sector. So on a median basis, financials are now under 10 times nominal, like absolute levels. I usually look at relative because they're more predictive, but absolute levels, when they're this anomalous, are predictive in and of themselves. And I think that that's one of the reasons, despite the fact that the Fed has not cut, despite the fact that the yield curve is inverted, despite the fact that some early profits have been a little bit worse than expected, financials as a sector have hung in there year to date. And I think that that's tipping its hand on what the financial sector is discounting. And to me, creates opportunity. That is not to say that I don't think former leadership like technology is a short or a sell by any stretch, but I do think that the market likely broadens out to include other, and we can't really call financial cyclical sectors, but you can certainly call industrials a cyclical sector. And I do think it's likely to broaden out into industrials, into financials, and into equal weighted consumer discretionary.
Okay, and so the consumer is fine, which also leads to sort of the question of how banks will do ultimately. In Canada, it certainly does on sort of a mortgage-related discussion. We're talking more about the US. How is the consumer? Still fine?
The average consumer is quite fine. And that is sort of the difference in terms of when you zoom out and look at the economy, or when you want to zoom in and look at the US consumer. There are parts of the US consumer that are absolutely struggling. We've certainly seen delinquency rates on autos and delinquency rates on credit cards renormalize and are still actually increasing. The lower you've seen in terms of wages, the more the US consumer is struggling. But on an average basis, that's what you need to look at, unfortunately, for the systemic shock for the overall economy. And that average US consumer is in pretty good shape. There's still some savings left. There's a lot of net worth left over. And net worth as a percentage of disposable income is still in aggregate at all-time highs. Job growth is still solid enough. So you're seeing this, the US consumer on an aggregate basis is in fine shape.
Amazing. Okay. And down at the bottom, where are we? You put technology still holding well. It's had these massive gains. It also has massive cash flows. And we got lots of earnings sort of peppered throughout the next little while here, lots of them rolling in. Tell us a bit about what's at the bottom, though, of the heap.
Yeah, at the bottom of the list, I'll still pick defense and energy, which I think is, related. And energy's had a decent outperformance run of late. I actually think that that's shifted the risk reward even more negative. So when I look at technology, when I look at energy, it's the exact opposite of technology. Their earnings have been good and are now declining, where technology's earnings have been poor and are reaccelerating. And that's true in terms of financials, look the opposite of energy. That's true in terms of industrials, look the opposite of energy. energy. So energy looks still to me to be what got us into this mess and what's not likely to be leadership on a durable earnings growth recovery. This is not to say the stocks aren't cheap. They are. But when you look back historically, cheap doesn't alter your odds very much when earnings growth is going against you. So I think that that's a complicated situation for energy, why it's still in my bottom three. But I'm going to add in consumer staples and utilities on top of that. I think that as much as they're also now probably, I'm not sure if utilities are cheap, but certainly consumer staples are cheap on relative forward PE and on relative trailing PE when you look at it historically. That, again, that alone will not really change your risk reward. And it won't even change your relative downside, meaning it doesn't skew in terms of their defensive capabilities. What you're really looking for is for earnings growth to have peaked in the rest of the sectors for the S&P 500. And we'll get there probably over the course of the next 12 to 18 months, but we're not there yet. So when you are in the midst of that, I'm going to go back to your mid-cycle vibes, or what I'm going to call an earnings growth, a robust, durable earnings growth recovery, you usually see consumer staples and utilities lag, and valuation doesn't offset it enough to sort of get rid of that relative earnings headwind that you are likely to see. So I think that the risk rewards for defensives and energy is still negative, and the risk rewards for, I'm going to call it cyclicals largely, and technology are still positive.
Do we have any visibility whether the discussion of utilities, again, in a sort of a longer term story of energy transition, are going to be needing a lot of CapEx? I mean, it goes to sort of where they're going in that story. They're reinventing themselves to an extent. Is there a cost story in there for them going forward that makes it perhaps even less attractive?
Be. There's certainly that CapEx story, in some ways that people argue that the growth in the CapEx, they will get a true return because they are regulated. Right. So that will be good over time. But when you look at CapEx, which again isn't a driver that typically people look at for utilities, but I do because we have the data, it is negatively correlated to your point. And I think that there are concerns that, and it's in part around that CapEx. Yes, it doesn't really come for free at some point. So it usually gets taken out, not necessarily of the return on equity that is sort of, let's call it more or less guaranteed and largely tied to interest rates, but it comes out in terms of multiple compression. So utilities, to your point, don't offer good odds, generally speaking. So when I back tested historically, it's about 35% odds of outperformance in any given year. The only thing that I've seen, and this is even including fundamentals, robust earnings growth, wherever you are on valuation trends, CapEx, even you can measure free cash flow, even though that they tell you that you shouldn't. The only thing that I've seen strongly correlate to utilities outperformance is a really down equity market. And by down, I mean usually more than 20%. Utilities are the classic defensive. So they are the classic negative correlation only in that scenario. So to me, that's really the risk reward improvement behind utilities if you are betting on that as an investor. But outside that case in which, my thesis in terms of the pause that refreshes doesn't create an opportunity for utilities there. And to your point, CapEx might actually be a headwind, not a tailwind.
Okay, really interesting. Let's circle back to where we began, which was a little bit the story of whack-a-mole on the economic data. You were taking a look at payrolls, ultimately what we should be looking for. We're constantly looking for different types of messages in the economic data to see whether rate hikes are going to do something. You've also told us that rate hikes might not be the whole story behind equities, and you've gone through that beautifully for us. Come back to the payroll story. We're going to get another one after this month ends. And again, what do we need to either look through or just sort of take on board?
If you feel like you need to look at data when payrolls come out, please look at the year-on-year growth rate. And I think that will show you the variability that's seasonally adjusted and whether it is, either stronger or weaker than what we think a normalized trend should look like. And that's the best advice I can give anybody who's looking at individual data points. The longer your time horizon, the more you focus in terms of where the data point is relative to a big historic trend, the more that can then inform your investment view. But hyper focus on month to month data, whether it be the CPI, whether it be payrolls, usually leads you astray, and you're missing the broader story in what's really driving the equity market. So it's more noise than it is signal.
Thank you for disguising that all in a fascinating conversation, all those little pieces that we don't necessarily take a look at. Denise Chisholm, thank you for joining us here today. Have a great rest of your day.
Always great to be here. Thanks, Pamela.